I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights to help boost your trading potential. Coming up, Wall Street back in action today. The markets are trending higher following President Trump's tariff relief for Europe. Bit of a reprieve on that one, plus Bitcoin's breakout as traders buzzing. But do the technicals suggest the rally has legs? And our trading debaters are standing by. They got the bull and bear debate on Best Buy, where it might go from here. That's all ahead. You're watching TD Active Trader Live. We're half an hour into the trading day. Wall Street is back to business after the Memorial long holiday weekend. And we got some green on the screen. It's a bit of a catch-up trade for the Americans reacting to trade developments over the weekend. That deadline for the threatened 50% tariff on the European Union, supposed to be June 1st, over the weekend got pushed to July 9th. So a bit of a reprieve for Europe. A bit of a sigh of relief for the markets. Let's check the heat map. We got a lot of green on the screen today. Tech appears to be leading the way, where there's Microsoft, Nvidia, Apple, Broadcom, Google. Not huge gains, but it's enough. They all put points on the table. Tesla up more than 4%. We'll get to that in a second. But because we didn't have Merger Monday and Acquisition Day, we got a little bit of that on Tuesday. Let's check in on Informatica shares right now. They were popping at the open. They're trending a bit lower. The stock actually moved higher on Friday on the rumors of what we learned to be true today. This is Salesforce buying the cloud data management firm Informatica for $8 billion. Of course, rumors of that deal had the stock on the move even beforehand, all about bolsterizing. I just made a new word. Bolstering the enterprise software giant's push into artificial intelligence. A deal actually fell apart last year, then the rumbles hit the market, and today we're learning all the details. Let's get back to Tesla. Stock's up. You think I must have some good news for you? Well, maybe it's a bit of a mixed bag, and investors are looking past the perhaps negative. Let's start with European sales for Tesla in the month of April, down 49% year over year. This is new data from the European Automobile Manufacturers Association. Tesla, of course, notably suffering due to Elon Musk's political work, but over the weekend, again, when the markets weren't open, Elon Musk did say that he's going to give more time to the operations at Tesla, less time on the politics. You put it all together, and the stock is getting a bid to the upside. And that's your market update. Joining us now for a more technical take on what's happening out there in the markets are our panelists, Hiran Amin and Jason Natick from our TD Direct Investing education team. Gentlemen, welcome back for another week.
Great to be back again, Greg.
All right, what are we digging into here? Well, we should also mention we have some special guests joining us, a live studio audience for the show. Always keeps us on our toes. Good to have you here. We'll get into it, try to give you a good program, and for the people watching on their computers as well. What do you got on the radar there?
All right, I'm going to take a page out of your cue. We're going to talk about Europe.
Okay.
I got an ETF pulled up here. It's DAX, DAX, all synonymous with Germany's index, the DAX, of course. That's the ETF we're looking at. And of course, there's the news coming out of the weekend. Friday, we had tariffs on, and Tuesday or Sunday, I should say, Sunday night, we have tariffs off. At least delayed, I should say, not tariffs off. So July 9th is when they got the reprieve to come work through a deal by then, and that's obviously seen the European markets just get a bit up there. But Germany in particular was more sensitive to these tariffs as a way, because Europe's biggest export into the US is vehicles and machinery. And guess what Germany's known for? It's vehicles. So a lot of these auto sectors as well within that space. So you have like BMW, Mercedes, the likes of those companies. Also see a bit of a bid up coming up into yesterday, which European markets were open yesterday. So almost like 3% to 1.7% rise up on there. Looking at this chart though, I've got the DAX ETF, which is broadly covering 40 of the largest and most liquid German companies on the Frankfurt Stock Exchange, and it's had a significant rise this year. We talk about the S&P being pretty much flat for the year, Greg, but in Europe it's a different case. They're outperforming the S&P, and DAX in particular is outperforming to the tune of close to about 30% there so far for the year, maintaining a strong uptrend over here. It's just on this regression channel still resisting right at this 21-day support. It's almost hit this new highs for the year, which is sitting at that 44 level. 40 is the next sort of support down there, but you can see very clearly the exponential moving averages are clearly in that uptrend momentum. momentum there. So that's going to still bolster that movement as well. And hopefully they've got a deal worked out to the end of July 9th, and we should see some continued upward momentum building off across there for this one.
Right, so that's the European action, the news, catch up over the weekend for the Americans. Bitcoin. People have been keeping their eyes on this one too. What do you see?
Digital gold. All right, so what's not been happening with Bitcoin, of course, in the last little while? So just pulling up the charts over here, just wanted to, as we know, Bitcoin is the world's most traded cryptocurrency and represents the largest piece of the crypto market, crypto market price. But what we've seen was we saw the break out of this downward channel that it formed at the start of this year. When it kind of hit that milestone 100,000 mark, just shy of that, and then it started going on this downtrend. But then after the upswings in April, we saw a significant bid up coming where it resumed this intermediate uptrend. Now it's kind of respected that at the moment. But what we also saw was with the exponential moving averages, they're now sloping upwards as well. So the 21 days firmly above the 50 and the 150-day moving average. In fact, the big news coming out of last week was Bitcoin hit its all-time new high, about $112,000. As you can see, we have it marked up over here on the chart. And we're also looking at this $106,000 level. That is now the support level that it could test down. One other thing I just wanted to peel back, because we saw an interesting stat come out last week as well. There's significant institutional demand. There's 2.75 billion in spot Bitcoin ETF inflows. And this marked the third highest weekly inflow in history that it's seen with Bitcoin. And it was over 25% of the total in 2024, just to give you context. But not all is rainbows and sunshine when you peel and beneath. When you look at there's a report by Glassstone, when you look at the sort of the data chain or the chain, what it tells us, the crypto chain, wallets that typically hold over $1 million in Bitcoin, they're considered what we call whales. And they've been unloading and selling into the retail space. So we've seen 9% drop in the sort of whale wallets.
What's the smart money doing, right?
It's smart money selling into the retail.
Right?
Exactly. So we're going to see this continue. If this continues, we should see a swing down coming to test that 106,000 level. There's still the gap down fill all the way at 80,000. I don't know if we're going to get there yet, but it is a fill. Typically in technical analysis, we know gaps tend to get filled there. So one to keep an eye on there.
Just next ETF you want to take a look at, also pegged on the news, has an interesting ticker, Nukes.
Nukes, yeah. You got to love it, right? So NUKZ is the one we're looking at. It's exchange traded, it's the Renaissance exchange traded nuclear ETF. So this ETF essentially just focuses on companies that are powering the future of clean and reliable nuclear energy. So it's going to give you exposure to anyone who's participating in nuclear energy, but also uranium producers as well. Now, this has been one of the best performing ETFs of the past year. It's gained almost 32% in the 12 months. But it also was voted or nominated for the top ETF for the year as well. Considers that. Now, why this one's an interesting play is because in May, the administration or President Trump just signed an executive order to speed up nuclear reactor approvals, cut environmental restrictions, and open also federal lands for nuclear power plant constructions. Now, this has definitely boosted the sector as a whole. So what you're also seeing on the backs of this is this gives you global exposure. The IEA Global Nuclear Energy Generation is expected to hit a high in 2025, and countries like China, India, you have Denmark and Belgium, South Korea, they're also loosening their restrictions on nuclear and becoming more pro-nuclear about it. So this fund boosts companies like Constellation Energy, which is the largest U.S. Producer of nuclear energy. They power about 16 million homes, and they're also partnered with Microsoft to power their AI data centers, which is kind of the new thing because they're huge energy sucks. Cameco also is a large uranium producer, which is also part of this. But just to go back to the charts, we've seen it kind of trade in this range-bound area. It's gone up to this uptrend again. We just saw this, what we call is a golden cross formation, where we saw the moving averages, the shorter-term moving averages move over the longer-term moving averages. And it's now testing those highs that initially hit back in February, that 52 level. There is a hanging man candle formation that's forming. One could argue there could be also an abandoned baby technical formation. You don't see it yet, but we see another gap down. And abandoned baby.
The abandoned baby.
Bullish abandoned baby. So all of this is to say these are signals that there's a possible reversal coming down. So if we do see a reversal, it could test back to the 21-day moving average, which is sitting at that $45 level. So we'll see how that shakes out over the next course of the weeks there.
The end of last week, and the White House had the European Union on their mind for tariffs. It wasn't the only thing they had on their mind for tariffs. So you're looking at another name.
Yeah, we've covered Apple on the show before, right? We know Apple's got a big exposure from a tariff perspective with a lot of their manufacturing being overseas, focused on China, India, Vietnam, big centers for those reciprocal tariffs. We also talked kind of interesting about kind of in terms of kind of the flights of the iPhone, where they had privately chartered jets bringing back the devices, their hardware, so they could front load and avoid tariffs. But the story's taken an interesting twist recently with the U.S. administration talking about actually proposing tariffs on a specific company as opposed to talking about like national government. So this is a unique development, and 25% on all of their hardware that's produced outside of the U.S. And this is really interesting because right now there's just not the capacity. They don't have supply chain. They don't have the skilled workforce, labor force in the U.S. domestic environment to actually produce their iPhones. But on the news, the company took a big 4% pullback on the proposed tariffs. This is big because let's see on my notes here. The iPhone is making up 58% of the revenues for Apple at large, and Apple,
the flagship product.
It's
right?
their flagship product, and you know what? I've got one in my pocket. I know many other people do as well. So it'd be interesting when it's time for an upgrade. What's that cost going to look like? But jumping into the chart, we can see coming off highs that we experienced towards the tail end of the year. Apple itself is down. A little over 23%, and if we bring it up now, they did find support, so they had a bit of a turning point here, around 194. So it wasn't all doom and gloom here, but there looks to be some near-term softness still in the market here. We've talked about it on the program before. Looking for W's, those double bottoms, those can be W's can turn into wins. Well, here we're seeing the M's with the double tops. That can be a negative sign on the chart. In this particular case, we've got a potential downward move, which would bring us down much closer towards those annual lows, around another 8.5% that could be shed based on the pattern we're seeing. And it looks like even with today's trading, we've confirmed the double bottom. We've now moved below, kind of below those previously established lows.
When you said we don't know what a future iPhone will cost, that's how I justified getting an iPhone 16 for myself recently. I have to have this. Well, I've got to get ahead of the action. So now I had the worst phone in the house, and I got the best phone in the house.
There you go.
But every once in a while, Dad wins. All right, thanks for that, gentlemen. If you have a question for our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website. You can find more information about all of our trading platforms under that Get Started tab, so you can find the one that is best suited for you. And if you're interested in trying out the TD Active Trader platform risk-free, you can open us a practice account. Click on that Try TD Active Trader button. It is time now for Trading Debating, the crown jewel of the show. This week, the stock in the spotlight is Best Buy. Before we get going on the debate, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors. Significant losses are possible. So it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. All right, let's get back to the stock of the hour. Best Buy, what made you guys pick this one to debate?
It's the largest pure play electronic retailer that's still around, I should say. There's a lot of them that are shut down, so it's one that's interesting to look at. It's it roughly holds about 8.3% of the North American kind of market, and it's got exposure to what's going on right now in the market. So a good one to look at, and then of course it has its earnings.
It sure does. And I'll even just say, selfishly, it's one of the companies out there that still remains, and I don't mind doing a little window shopping. And whether or not it's in store or online, you can go and just browse and see what's out there. What's the next new thing coming out from a personal device perspective, or whatever other the things that they're selling. So yeah,
he said there was window shopping. So
little window shopping.
Yeah.
All right, let's get some time on the clock. Then you usually get 2.5 minutes each to make your case, and we'll give you some time to counter. As always, you just draw from a hat. Kieran, you got the bear case. You're going to kick things off first. I got a bell here to keep you honest with your timing. And let's get the time on the clock. Go for it.
All right. So I'm going to present the bearish case for Best Buy, of course. Best Buy is a company that's, and its stock, I should say, that's rooted in structural, financial, macroeconomic challenges that really are going to undermine its long-term growth potential and even its current valuation by its means. So here are the points that I'm going to talk about here. So first and foremost, you've got weakening financial performance and sales declines. That's a big thing. Everyone invests because they want a company to grow and make money. This is a company that's not doing that. So if you look at the upcoming quarter, it looks to mark Best Buy's 14th. Keep that number in check. Consecutive year-on-year decline in total revenues, okay? If you look at just the metrics alone, they've had over a 3-year span, their compounded annual growth rate on the revenue, it's -7%. So they're losing money each year in terms of the top line numbers that they have. I also looked at the 10-year analysis on their revenue, and it kind of is very cyclical. So from 2012, they were hit about 50 billion, and they cycled down all the way into the mid, about 2017, where they bottomed down to about 38 billion. They picked up back to about 50 billion, and we're starting that cycle again now. So they're back down to about the 41 billion estimate. So we're going through this revenue drawdown cycle again that they're going through. The other thing is the guidance that the company's issued. They've said, come out, we're going to experience negative comparable growth sales. And that's weighed down by consumer confidence, that's declining, especially coming out of this quarter, which was April, and those tariffs came in margin. And then we've got squeezing margins, of course. I'll talk about the tariffs in just a moment when I come back. But let's go to the chart and let's show you what's unfolding here, because the market is in sync with what the fundamentals are showing. We see a long-term downtrend. I've kind of drawn this out going back quite a few years here, and we see this long-term downtrend. It's kind of touched it, but has never been able to break above it. Now, of course, what we saw coming into April was, like every stock and retailers, we saw the big drawdown happen. It was on this uptrend, and maybe Jay will argue that it started this uptrend, but I'm going to counter-argue that and say it's broken below that uptrend again, and is now resting against its 2024 lows, which I've marked over here. Now, what you're going to see as well is the exponential moving averages, they're sloping downwards, they're almost flatlining. The stock's actually piercing and breaking below its short-term, it's well below its 150-day moving average. So this stock is still going to see downward pressure. This is the level I'm looking at. The major support is sitting in that $47 to $50 zone, which we could see test down below this coming out of this report.
All right, Heron came swinging right out of the gate there,
that
Jason.
felt a little bruised, but that almost felt personal there a little bit. But
defend yourself.
I try to do that a bit.
All right, back off vacation in here, and you're right back into the fire. I like it. All right, so Best Buy is a company that knows what it's good at. It puts stock in what customers say. It responds to feedback, how they're feeling. But what I also really like about the company is that they're not afraid to change. They can sit there and kind of dwell in mediocrity and the slow, steady decline of like the big box brick and mortar stores. But this is something that they've not been willing to do. And there's 3 things that I think that really kind of points to the company making headways and then points to a positive future outlook. One is going to be an expanded offering. This isn't just a store where you can go in and get your iPhone. This isn't a store where you're just going to go get your video games. They've got a whole suite. You can deck out your house from kitchen to laundry room to bedroom. They're even offering beauty products. And if you even want to maybe get an e-bike so you can make trips back and forth to the store to home to pick up your products, they're now offering those too. So a wide suite of offerings is going to help them sustain and compete in the space. Second thing is this may have been brought along by COVID, but it's something they've been able to perfect. They've been able to double down on, and we're talking about same-day delivery, same-door pickup. When we're thinking about competition, we're thinking the Amazons of the world and then the like. This is an opportunity where many offers or many orders are ready within the hour, and when you've got 1,100 locations spread across North America, it really makes it easy for you to get there. And in fact, and the next thing we'll talk about is online sales. Pre-2020, their online sales were less than 19% of all of their revenue. That number has climbed to nearly 40%, and we're talking significant year-over-year growth. And when we think that, then last year they had a 2.65% uptick in terms of their revenues through online channels, cresting over $5 billion. So the needle's pointing up in terms of making it easily and efficient to buy. But looking back to the chart here, sure, there's always going to be ebbs and flows. Every company trades within a range. Best Buy is no different. We can see I've got the range marked out on the chart. We did have a significant drop down below, but we've breached back above. And let's take a nice, like a little bit closer look here. When we broach back above, let me zoom in so it's a little bit more visible here. Now, mind you, when you look for patterns, they're not always going to be your standard textbook definitions, but we've got a head and shoulders padding. We got a left shoulder, head and shoulders with an upsloping neckline. That's showing once we've broken back above into our range, we broke broken up, and we have some upside that's showing on a near-term chart. This is something which I think is forming in a significant area because we gap down to these lower levels that Hiran was talking about. But if we can get this measured move above the 6.5%, that's going to push us back over the gap, push us back over near-term support, which might be a nice launching pad for after earnings.
All right, that was a civilized part of the debate. Now you guys get to go at each other for 3 minutes. Someone's got to speak first, so Hiran can
All
speak
right,
first.
I'm going to start by saying, Jay, I think it's cute that you think
Oh,
that.
We're getting really personal now.
Yeah, by
Okay.
selling lipstick and makeup and home furniture, right? You have to remember what is Best Buy's key revenue generator? It's their electronics, the phones, the computers, and guess what? It is facing intense competition from direct-to-consumer brands that they already subscribe with. Samsung, Apple, amongst some of them. You've got Amazon, which controls 50% of the e-commerce market space that they're going against, the behemoth there. And as you said in your opening, it's nice to go for window shopping. I think that's what everyone does. We like to touch and feel it, but we don't want to end up purchasing it from that store because we end up going to Apple or we'll go on
And
Amazon and do the buys.
showcasing.
Exactly.
Well, here talking about showcasing, like if they're learning from their competitors, they're not, like as I said, they're not confident. They're not just happy with the status quo. Best Buy's actually developed a marketplace that's allowed them to bring in third-party resellers there's significant opportunity. It's basically created an online mall on their shopping properties in their websites. There's potential to monetize. There's search data. There's opportunities to create in-house ads to fulfill those revenues. So it's an opportunity. And when we're thinking outside of the U.S., like here in the Canadian marketplace, it's big. They partner with a company called Ping Pong, which is a worldwide leader in this type of endeavor. So they're able to bring in global resellers to bring those products at attractive prices, all in their stops. They're not forcing their consumers to go to other destinations.
Yeah, but listen, even with that being said, Best Buy's fundamental issue is one thing. They've sourced 60% of their products from which country? Say it. China.
You're going to make him say it. I'm going to humiliate you, Jason. Say it. Say the word.
And they know it with every 10% in tariffs is what they calculated. The management said that we're going to see a 1% margin compression on our profits. Currently, it sits at 30%. The deal's being extended, worked out. Who knows how long it's going to take? So this quarter coming into it, they're going to feel significant pressure coming into it, and they'll probably be able to give some sort of sense of what this could mean for the long term. Also, their in-house brands, Insignia and Rocket Fish, which again are probably manufactured in China, which is their private labels that they have, are going to face higher costs that you have. Now, even when you talk about e-commerce and partnering with all these other players, you've still got Amazon, that's the big one that's there. And, this is not a new foray that Best Buy has gone into with e-commerce. They tried this a while back. And it didn't pan out quite the way. Maybe in the U.S. it didn't. In Canada, they've started, opening up to third-party resellers. Yeah. But the U.S. market is nowhere close.
Here's a new foray. Here's a new foray from them. They once again trying new things, see what works. Is there micro locations? They've opened up big spots. Like we're thinking about that. People feel comfortable going to trying to put something in their hand. They want to see how a device feels. But they've opened up here just once again Canada being a test market. 167 micro locations for their Best Buy Expresses. So these are markets where they would never have exposure to. So they've really made an opportunity to get as many boots into the store. And
Okay.
You're respecting the bell. I feel powerful
not like
today.
me.
That's not like you at all. I feel powerful today. I don't know what's going on. Nice spirited debate. Now we can jump into the platform, and both you gentlemen can tell us how you could potentially play your positions through option strategies. Take it away, Hiran.
Absolutely. So let me just switch my chart out here, and I'm going to bring up the Fibonacci levels. So since I'm taking obviously defending the bearish stance on this on the stock, I've just pulled up the Fibonacci levels. Just gives us a sense of if there's retracements from the highs. We can see that downtrend off of the 100 level coming down to this 54 level. We know there's usually retracements at the 50% level and then the 61.8, which is the golden ratio, which is still a bit of room to go. But I'm not certain it can even get there because it's teetering on the 23.8 level right now, and we could see a further breakdown. The last time it had earnings, it gapped down about $10. And if we could, coming into this earnings on Thursday, we could see another gap down similar, especially because they've said we've given negative guidance. But I don't think they've priced in the tariff conversation yet, and we should be able to get that. So with that being said, the trade that I would be looking at considering, I'm going to bring up the options chain now, is going to be a put ratio spread, a debit put ratio spread to be specific. I've looked out to because it's a net long trade, I'm going to be spending money. It's a debit trade. I'm looking about 52 days out on the July cycle. Essentially what this trade is when you're putting on a put debit ratio spread is you're looking to buy in the money put option. So in this case, we're going to be doing the 72.5 purchase, and we're going to be doing a 10-point spread out of it. So we're going to sell the 62.5. And here's where the ratio comes in. I'm not typically you would just sell a single contract, but here we're going to be selling 2 contracts on this. Now, part and parcel of this reason is, one, it helps me with the cost. So if you can see the cost right now, which is about $5.60 on the 72.5, and if I were to just sell a single 62.5, I'd get about just shy of $2. But by selling 2 of those contracts, I get about $4. So my break even, or my net cost, ends up being about $2 or so is what I'm spending here. So with this trade, what we're looking to do is we're looking to profit with the move down, but I wanted to only kind of take a pause at that 62.5 level, which is going to be about that 10-point move that we're anticipating happening over here. So if I just pull up the risk profile, Greg, I've just got this mapped out over here, and it just kind of shows you what this trade looks like. So, because I know we want to talk about what's the downside to this,
Exactly.
what's the upside to this.
There's always a risk.
Absolutely. So the downside to this is going to be one of 2 things. One is if the stock really has an outsized move beyond the 62.5, that's when I'll start losing my profit. But that break even doesn't happen because until 62.5, I've still made the difference on my profit, which is the $10 minus the $2, which is roughly about $8. So on the downside, I'm looking at about 52. Beyond 52 is when we start losing money on there. That's how much it would need to go to. But on the upside, because we're doing a credit, if it doesn't move down on the downside at all and just goes up on the other side, then we'll lose what we spent, which is going to be the $2 that we're putting in onto this trade there. So that's what I'm looking at, and yeah, see how that shakes out.
Interesting trade. How could a bull play it?
Okay, so one of the things we think about here is do I do a debit spread or can I do a credit spread? If I'm thinking about doing spreads, and spreads tend to be a default for me because they do offer some risk definition. I know that I'm either spending less money going up front, or I'm capping my loss potential if it happens to go against me. The deciding factors between doing debits and credits are debits are very directional. It needs to go in that particular direction of the trade. Otherwise, I'm not going to make any money. The credit spreads, while they come along with a little bit more risk, they do give me some flexibility. I can make money in all 3 directions of price movement. If it's consolidating at one price, if it moves up or it moves down, just as long as it doesn't move up by too much in my particular case here. I've got a chart here to kind of visualize the discussion. On the chart, I know Hiran was poking me for previously about putting lots of stuff on my charts here, but this I want to talk through this for the audience. The red lines, that's the expected range that I've kind of drawn on to. I've been able to gather that by kind of adding up the at-the-money straddle, so that's showing where the stock is expected to go. The white lines, those are the strike prices that I've chosen, so it helps me to visualize what I want the stock to, or what I don't want the stock to do. If I'm doing a bull put spread in this particular case, I want it to expire worthless so we can see where the stock is trading. I do not want it to trade down and cross through my strike prices, so that's going to create a potential loss for me if it drops by too much. And then what I've actually drawn in here as well, just for a little bit of extra color, is this green line. This will be my break even on the trade. So if it drops below that point, that's where it puts me at a loss. And I've been able to put a probability out of the money on that. That break even is still 75% probability out of the money, which, still I'm 3/4 likely to walk away with profit, and we're talking almost 70% likely to walk away with full profit. So going back to the option chain just quickly, I propose doing as I said, a bull put spread out to June. We're giving it a little bit of time to maximize some of that time on the trade, but we're still going to experience some volatility compression after earnings that comes up later in the week. But propose selling a $65 put and then buying for insurance purposes, buying the $60 put on the downside so that I've got that downside protection. So through buying that put, I'm giving away some of my upside potential, my premium that I've been able to get on that. Right now the 65s are sitting at like a 25 deltas, meaning I'm highly probable to expire out of the money, which is good for me. If you're feeling a little bit more bullish or willing to take on a little bit more risk, you can sell a higher strike like a 66 or a 67 and take in a little bit of extra premium, but you're taking a little extra risk on that side as well.
All right. Both interesting ideas and a spirited debate. Thanks for that, guys.
Yeah. Thank you.
The bear and bull cases for Best Buy. Just a reminder to our viewers that this debate was for educational purposes. It does not reflect our personal opinions about the stock. Now, before we move on, Jason, you're going to elaborate on how to customize your workspace in the Active Trader platform.
Yeah, I really wanted to make sure we took some time to do this because this is kind of one of the hallmark features of the platform. There's no one size fits all. We've got a lot of great tools that are baked into this, and our development team has spent a lot of time and effort to put them in a way that we think is usable. But hey, You've customized your platform, I've customized my platform. I know you even customized your Prax account as well. So it's a way that you can really make sure that things are set up in the way that you want to use them, and so that you can really kind of focus on the information that's important to you. And for that matter, it's also a little bit of a shameless plug. Tomorrow I'm running a masterclass on the platform. It's all about getting started on the platform. One of the key components of that class is we're going to be focusing on the ways you can customize it and really get the most out of it. So let's jump in here. I'll show you how to quickly make a workspace. So we've got all of our workspaces at the top of the screen here. This plus button after the education tab. By the way, the education tab has got a lot of great videos on how to use some features on the platform. But clicking this plus button brings me to kind of a blank canvas where I can go up to the widget bar up in the top left-hand corner and choose the tools that I want to add into me. I'm going to keep this pretty simple. I'm going to put a watch list, a chart, and an option chain. There's many more variations, infinite possibilities here, but let's show how easy this can be done. All of the tools that I'm talking about happen to be found under the trading tab. So if I go trading and watch list, I'm going to click that in. The default watch list happens to be our continuous futures, so you can keep track of kind of those future contracts. But if we wanted to add in my own list, we can go ahead and get that done. All right, let's go ahead and start adding in some extra features. So back to our widget menu at the top. Under trading, we've got charts. I can just click charts and it'll add it into the platform, but I want to have a little control of where this is going to go. So I click and hold and drag this out. Notice the highlighted area. This is exactly where the chart feature is going to drop onto my platform. So releasing that, now we can see I've got a watch list and a chart. The last thing I want to do, let's shrink down the watch list a little bit. The last thing we're going to add in is our option chain. So going back to widget, under trading, option chain happens to be there as well. Dragging and dropping, it's out. The last thing we'll focus on really to make sure that we can get the most out of the platform is we want to minimize the clicks so we can get to information quickly. That's linking these tools together. Up at the top of the page, this chain link, if I set this all to the same color, that is going to make sure, let's get that maximized so I can link it properly, and then we'll minimize it back. If I link everything to red, that will mean that everything is talking on the same channel, and it's all going to be nice and easy and able to me. If I click on Tesla from my watch list, noticing how my chart and my chain is ready to go, and I can add in any other tools that's found on the platform into my own workspaces. So once again, no one size fits all.
I love the linking. I got everything linked. Everything links together. It just makes sense, right?
It does. It makes it easy.
All right. If there's a stock you want to see our debaters go head-to-head on, send your suggestion to td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website. And if you can't join us live, be sure to visit our YouTube page where you can catch up on all our previous debates. The link is right there at the top. And don't forget, once you're there, to like and to subscribe. The news never stops. Always keeping our eye on the terminals, even when we're doing the live show. Plenty more to come this week. Before we say goodbye for another week, what do you got on the radar?
All right, just going to do a recap on what the macro key events that are happening this week, Greg. FOMC meeting minutes will be released. This is basically the behind-the-scenes look at what influenced the Fed's decision coming out of their meeting earlier this month. So traders, economists, and investors are going to closely watch those and look for clues what's going to play out for the next meeting that they have, and overall the interest rate outlook. Also, GDP numbers now. This is something I was talking about. I wasn't aware of, but they actually do 2 revisions of that. So this is they had the advanced numbers coming.
I feel like the US GDP is endless revisions.
Endless revisions. So this is the second estimate that's coming out on Wednesday. Now this will be a more refined insight. It'll have more data that'll be incorporated into it. And expectations from BofA economists and Wells Fargo are suggesting a downward revision of a negative 0.5% annualized growth from the initial negative 0.3%. So coming slightly lower. And then finally, of course, the big one on Thursday will be PCE. So for April. So this is the Fed's preferred, price index for inflation. And so headline is expected to rise 2.2% year over year, down from 2.3% in March. And core, which takes out the volatility of food and energy, that's expected to remain 2.6% year over year there. But the other one I'm looking at is Gap Inc. specifically. So a retailer, clothing retailer, we might have heard of it, of course. There are 4 distinct brands under its sort of holding umbrella. Gap itself, Old Navy, Banana Republic.
Gap, but then you got something from Banana Republic.
Yeah, exactly. And maybe it's, it outfitted us here, but they've had a pretty strong run of their earnings over the last few quarters, in fact. So coming into this one, they're looking at $3.4 billion on the upside for revenue. That's going to be a 0.9% increase year over year. And on the EPS side, it's going to be 44 cents. So that's a 7.3% increase. They've actually, for the trailing 4 quarters, they've had earnings surprise of 77.5% on average. So this is how much they beat the market. So given this momentum coming into this, now they don't quite have an exposure, but tariffs is going to probably be a factor in this. They have, a lot of the clothing is made in the Southeast Asia region. So we'll see what they say about that and how that's going to affect their bottom line there. But looking at the chart, we've seen it come off the strong uptrend off of those lows in April. It's maintained this uptrend. It's formed the golden cross, which we like again, 50-day moving average crossing over the 200-day moving average. But there is a gap down filled right now that's looking to be filled. So if they do, if they have a negative surprise, then we could see it come teeter down. But it is touching this $29 resistance, which is kind of mapped out. We could see another push higher should those earnings continue to surprise as they have in the past.
I think this shirt might actually be Banana Republic. You can check the tag after the end of the show. When you said maybe we're even outfitted by them, I was like,
yeah, I got it. It's out of me.
I think it might actually be. Jay, what are you taking away? You're dressed well. You're feeling good. Maybe you need something on the
Not
face.
Not only from the Gap family, but still trying to rock it pretty nicely here. But I'm going to talk about something called, Ulta Beauty is the stock on the radar for me. But have you ever heard of something called the lipstick index?
The lipstick
index. So this is something. It's an economic theory. It's a real thing.
About how good we're feeling about the economy.
Yeah, it is. It's a theory that suggests that the sales of affordable luxury goods like lipstick increase during times of economic hardships. This was actually coined. Now, mind you, it was coined by an industry insider, Leonard Lauder, former chairman of Estee Lauder, coined this term when he observed trends and upticks in sales of affordable luxury goods like lipsticks and nail polishes and things like that just after 9/11. People wanted to feel good about themselves, so they went and bought those bigger, maybe they left larger purchases for luxury goods to the side and were able to treat themselves to make themselves feel good. But Ulta, it's a specialty beauty retailer. They sell more than just lipstick. They've got salons and things like that, and over 1,400 retail locations. Expectations have been a bit of a mixed bag for them, with earnings per share projections coming in, let's say 11% lower than the previous year, but their revenues are expected to be up in the second quarter. So we're talking up 2.2%. So a bit of wait and see, but there's some interesting facts coming out of. There's been 5 analysts actually coming from lots of different houses around the industry have all reaffirmed their present stances. So the market is kind of comfortable where the stock is. We'll wait to see how things come up on Thursday when the earnings hit. So let's jump to the chart. Pretty well-defined pattern for Ulta over the last year. The things that kind of really jumped out at me, we did see a gap up, but it did hesitate to break over that 424 zone that it's been trading in. But it's not dropped back below the gap, so that gap hasn't been filled. It's held in time. So we'll see if that can continue that strength, and maybe that'll be a springboard past that glass ceiling that it's had in place for the last year. But Thursday's gonna be a big day for them.
And before we know it, it's going to be June. Something pretty significant happens, at least for our team and here at TD in June, Options Education Month.
You got that right, yeah. So, we've got... who's
Who wants to say something? Yeah. I took him by surprise, like, what? Oh, my God, I better get busy. I got classes to teach next month.
This is one of our it's one of our flagship events, right? We've got a full court press. We've got new content coming our way. There's going to be something there for all options skill levels there. I really think our viewers will get a lot out of it. So
yeah. We've come up with a new series as well, workshops. Kind of what we do right now, but we'll be able to spend like a good hour with our audience and take them through the life of an options trade. So both me and Jay are going to be featuring we're going to be taking a bullish series, and he'll be doing the bullish. I'll be doing a bearish series on a number of different stocks. So one to tune in. We're going to do that weekly, and a lot of these strategies we talk about, we've dissected those into these classes that you can join, like the wheel strategy is one of the big ones, and how to trade options in a small account as well. So these are kind of our marquee sort of novel concepts. Classes that we're bringing out this year. And then we've got some great guests. We've got the Inside Investing show that we host as well, where we've got outsider guests, industry professionals in the options world that we're going to get on the show as well. So a lot to tune in for.
Lots of airtime for the Active Trader platform too. So we're remiss to say that it's going to make sure it has its time in the sun as well.
Excellent. Absolutely. You don't want to miss it. I notice we got the lights back on our studio audience. I don't know if you can take a shot of them. Am I incorrect in thinking that the jobs that you do right now, and you're the best of the best, I'm told, of those jobs, you guys used to do those jobs?
We used to.
So that means any one of these people in the audience could one day be a panelist on this show.
They could, very well.
I'm putting all the pieces together. Just bear in mind, we're not going to make you do it next week or right now, but could be in your future, all right? That's all the show we got for this week. As always, investors should perform their own due diligence before trading. Thanks for watching, and we'll see you again next Tuesday.